Hi, everybody. Welcome back. Mynor Ramos here, and I am joined by Michael Domico. So we've been going over the four pillars. Actually, this will be the last one. This is the OPM strategy. Now, here's what's really interesting. I want you to, I want to put a illustration in your head. Go to any downtown area that you're familiar with. In the downtown area, there's going to be a lot of buildings, and a lot of them are going to have names, and they're certainly not clothing or cars. They're banking institutions. There's a reason. There is a reason why that exists. And we're going to talk a little bit about that. Thinking like a banker, talking like a banker, and acting like a banker. And just the idea of just that banking arbitrage. But today, Mike Domico is going to explain to us, get into a little bit, for someone who's never heard the concept before, very brief, let them know about OPM, which means
other people's money.
take it away.
Mynor, thank you so much. I appreciate the opportunity. So Mynor hit it right on the head. You don't see too many buildings by names other than bankers, financial institutions, and people that just made a lot of money. And the reason for that is that they love working on your money and my money. And this particular type of insurance and ideas on how to invest your money is called a lot of things. But OPM, other people's money, is the most accurate that I know of, and I love it. So in a nutshell, let's just look at what it's all about. So there's most people out there, whether you're a professional who sells the product or the average public that's buying the product, understands life insurance. It's very simple. You pay an insurance company, a large company who's just like a bank and sometimes worse, a premium. And for that, they promise that if something happens to you, they're going to pay somebody something. And if nothing happens to you, then you may even get some money back. Well, that's not all bad. So, I like tell my clients, I'd much rather deliver a retirement check than a death benefit. However, either way, that's the simple process. You pay a premium, you get a policy. What OPM says, and what the banks and the financial institutions that are backing it say, there are ways that we, in this case being, a bank or an investment company, can make money if we loan it to people that are buying these insurance policies. And of course, they're taking the same principle as the bank. And that's all well and good. Because like I tell my clients, there's nothing wrong with learning from the people that are much better at it than we are. And the banks and insurance companies are certainly that. So I'm not interested in explaining too much about how the bank does its side. But here's what I am interested in explaining. Let's use a real simple example. I was looking one just the other night. This was a client who put in $25,000 into his program for 2 years and decided that's all they were going to do. Now, where the money came from doesn't matter. There's no tax ramifications here on the premium. These are just real premium dollars that he paid. So he paid $50,000 over a 2-year period, 24 months. He then sat down with a financial planner who said, look, we can get a bank or a financial institution that will loan you money that you can put into your life insurance program or your other people's money program. And you get the arbitrage between not just the $50,000 that you put in and the return, but the arbitrage on the $50,000 you put in plus all the money that they lent you. And again, the reason they're doing it is they're making money. So we don't care too much about the reason they're doing it. But the point is, that's possible. Well, okay, sounds like almost free money to me. How do I get on the bandwagon? Well, real simple. One of the few qualifications is you have to be making $100,000 a year or more for at least 2 years to be considered for the program. And that's just to show your credit worthiness and your ability to handle cash. Having said that, the bank's going to turn around, or the financial institution, and they're going to loan you money on that policy. So every year after the first 2 years, instead of you putting more money in, the bank's going to put in money for you. Depending on what plan you choose, it could be anywhere from another 25 or 30,000 up to maybe 100 grand a year. It depends. There's a lot of variables in there. So each case is going to be different. But here's what is important. You're never going to pay that money back, whatever it is. Why? Well, because the banking institution, the financial institutions involved, are satisfied with getting their money back as part of the death benefit when you finally leave this earth. Now, you say, okay, well, that doesn't sound like it makes much sense. Okay, fine. Maybe it doesn't. It does to the bank. It does to the financial institution. What's important for our end, what's important for our clients, is that at age 55, 60, 65, whatever age they decide to retire, we can now show them how to start taking an income off of that money. Now, remember, it's off of not just the 50,000 that you put in. It's off the 50,000 plus whatever the bank put in. And that's where the arbitrage comes in. Arbitrage simply is the difference between what you put in and what you take out. So we know the bank's money is going to be underwritten by the life insurance policy. They're going to get it out someday. We know that you're going to take out money, and you're going to take it out based on the total that was put in. So for the 50,000 that you put in at age 60, you could easily be talking about taking out $30, $40, $50,000 a year for the rest of your life, for your retirement, and never pay taxes. Now, you said it's got to be too good to be true. Well, yeah, except when you get into it, if everybody's making money, everybody's happy, and that's a good deal. It's not you making money at their expense or they making money at your expense, unlike normal banking procedures. So it does work. It's not for everybody. And you have to be talking long range. Can you access the cash quicker than retirement? Yeah, you can, but that's not always to your best benefit. So make sure that your professional sits down with you, explains exactly how it's outlined, and that, you can get the arbitrage for long range return on your money. And that's what we're after, the long range return.
It is a level 3 finance type of person, not the person that's living paycheck to paycheck, not the person who just made, a couple bucks on their money. It's someone who understands now the aspect of redirecting that money and making sure that there's a velocity there's a movement of that money, not to be confused with, maybe there are some life insurance agents listening to this that might be interested in getting this because maybe they're in the captive world and want to be in the independent world. Some of them may have heard the term premium financing, which there's nothing wrong with it, but this is not what we're talking about. We want to make sure that it's clear. And then in the video, in the webinars, we'll put a link to the information. We'll put a link to our contact. Most of the times, I always thought about this, why isn't life insurance sold on the internet? Why can't somebody just go to Walmart and go to a kiosk and buy life insurance? Because it takes people to not only understand where is the individual, what does the individual want to accomplish, where are they at, where are they going, where is their from and to, and then it takes someone who's been down the block a little bit. These are not your typical policies that everybody that just got licenses is writing out there. They might be talking about IUL, they might be talking about term. Well, listen, there's a lot that goes into it that you need someone who is an expert at it. I certainly, trust, your ability. I know I've done a few of these, and it's just knowing exactly where to go. So the information will be in the link. Please go ahead and take a look at that. Of course, we're talking about advanced insurance. We're talking about, these are strategies for the advanced. So some of you will continue to follow us, and we can't wait for you guys to hear, and watch our next our future videos. Until then, Michael, thank you very much, and guys, come and watch us again.
Mynor, thank you.
Absolutely.